So to kick things off, please welcome our very special guest today, CEO of Animoca Brands, Robby Yung. Robby, let's jump into it. The reason why and thank you so much for coming. Last week, your team announced you're launching a $2 billion metaverse fund. Let's tackle that right away. Animoca is already a behemoth in this space. Why now? Why 2 billion when everyone else is kind of falling by the wayside? Walk me through the logic.
Sure. I think maybe the first thing to say is I think timing is just, it is what it is. I think as a game developer and metaverse builder, if you will, we're less concerned about market cycles specifically, because obviously we're not a financial advisor, for example. And I think that for us, this is the evolution of a plan of how we can continue building the ecosystem and helping the companies that we work with. So we've spent a lot of time over the last 4 or 5 years making investments at seed and Series A stage, largely at the very early stages. We also have an accelerator in Hong Kong for sort of NFT and Web3 culture. And so we've been quite, I think, successful in working with companies at the earliest stages. And as time has gone by, we've thought about, as some of those companies have now become quite big, some of our earliest investments in companies like OpenSea and Dapper Labs and Sky Mavis, YGG, these companies have, by valuation, become quite large. And there are great opportunities to make follow-on investments in those businesses. In most cases, we also have rights to make those follow-on investments. And yet it doesn't necessarily make sense for us as a corporate to be making investments of that size anymore, because that's beyond our early stage strategic mission. And so what do we do with those rights? We thought, okay, maybe we should try to come up with some other type of vehicle to take advantage of those rights. And that was kind of the original seed of the idea. And then we thought about the market cycles and we thought about where Web3 is in terms of its stage of evolution. And, digital assets have been around for a long time, the entertainment side of Web3 more recently. But our view is that the market is reaching such a stage of development, if you look at some of the more mature companies, that we will start seeing public offerings and listings before too long. And so I think that was the impetus behind setting up what's essentially more of a growth stage fund, more of a traditional private equity fund geared towards pre-IPO situations and looking at kind of a 5-year time horizon. The assumption being that, probably 2 or 3 years from now, we're going to start seeing potential IPO situations coming from Web3.
That's really encouraging. A lot of the larger shops right now are in the trade finance space are going through a vicious valuation rebasing as liquidity is kind of drying up from the private markets. And they are launching Fund 4, Fund 5, Fund 6, really more as a vehicle to help them offload or create liquidity events for the previous funds. But here you are, you're actually building the next fund really as an opportunity set because of the development cycle. You kind of answered my second question to an extent, which had to do with historically, Animoca has been, as you say, a VC investor. And so when you look at the time horizon for your investment decisions, they're usually quite long, but then you have these shorter term, not obligations, but expectations that you need to manage. Walk me through how that looks, because even for the new metaverse fund, we're still years out from some of these liquidity events or listings. And how do you divvy up the portfolio in such a way that you can manage expectations properly?
Sure. I think one of the things that we've done over the last couple of years is we've started to evolve the structure of our investment strategy. So when we began making investments in other companies in the Web3 space, it was purely as a corporate VC. These were strategic investments straight off the balance sheet. And we still do that. Although I think what's happened is that the investments we make from the balance sheet have become more strategic in nature, if you will, meaning not just strategic for the Web3 ecosystem, but specifically for our operating business. And we have also then raised specific investment vehicles to make more of this sort of ecosystem support type investments. So we raised a venture fund last year called Animoca Ventures, which is a 100 million early stage venture fund. And we do a lot of early stage investing through that vehicle. And now we're having this growth stage fund as well as the accelerator. So we have 3 dedicated vehicles for companies at different stages of development. And that way, hopefully we can be a good partner with companies from the earliest stages all the way through to IPO, both strategically and financially.
Got it. So so I understand now I'm trying to imagine what the pitch looks like because Robbie, you actually come from corporate development side yourself, raising
Mhm.
capital for the firm, et cetera. So articulating the position of the firm to investors is always going to be tricky. What kind of pushback are you seeing from investors now, and how are you getting them around to the idea of this thesis?
Sure. I think in terms of pushback, the only pushback that I'm seeing is valuation. I'm not seeing any particular hesitancy on sector because I think honestly, what happened with FTX, I think is quite a different scenario than what happened with Luna and Terra and other sort of market anomalies, let's call it, earlier on in the year. Because in the case of FTX, there was what appears at least to be criminal activity. And so it's I think it's an event that gives investors an opportunity to reprice because, obviously you take what you can and use it as leverage in the marketplace. But I think that it doesn't necessarily discourage investors from, it doesn't call into question the validity of the industry or the validity of business models. Even in the case of Luna and Terra and 3AC and stuff, there were questions behind risk management practices and competence, if you will, in terms of risk management. But I think that investors are very comfortable with the idea that digital assets are a class that's here to stay. And particularly in the case of our business, that they're a fantastic foundation for how content is moving forward, and that entertainment really does appear to be pursuing the path of true digital ownership.
Yeah, I think you touched on a really good point here and I think investors need to remember there is, with crypto and digital assets in the crypto space coming down so dramatically, this doesn't necessarily mean that there is a massive rebasing in the PEVC side, which is actually TradeFi very much. So walk us through how you are running valuations now. A lot of these companies at the VC level are pre-revenue. Some of them even in mid-stage are pre-revenue. Give us sort of like a primer on how the team approaches valuation, and more importantly, how does that valuation approach differ today than it was 6 months ago? Because I imagine you're spoiled for choice now. You've got a lot of opportunities.
Sure.
You have distressed companies with great products, and then you have new companies that are, they raised decent capital last year and are halfway down the roadmap.
So I think from a valuation standpoint, obviously, it's at the moment, I find it's in terms of new companies that approach us, often we're looking at very traditional metrics in the absence of EBITDA. Typically, we're looking at revenue generation and revenue traction and maybe a multiple thereof, although sometimes that multiple is just one. And I think that there's a lot of reference pricing going on as well, I see at the moment. So companies that, for example, may have raised 9 months or 12 months ago, are taking a haircut now, sometimes substantially. I'd say for companies that are looking as if they're, a little bit more in need of cash, let's say, then you're probably looking at maybe 50% discounts. But companies that are strong and actually just trying to build out product and expand market share and market position now as a result, but who don't actually need money, those companies, frankly, are still raising flat or up. And it was a shame, frankly, that I had a couple of investee companies that were raising just prior to FTX, and that the whole situation just ended up basically being an excuse to push closing into January. So it's a timing issue. It's one of those things that this happened in November, and so investors are happy to take an excuse to just sit on good returns for the year probably, and come back to things in January. But I don't think that it's quelled any of the interest, frankly, in the sector, which is the thing I find most encouraging. And frankly, I think we probably would have had this same conversation 6 months ago after Terra and Luna, where I think you see investors taking a more cautious approach and maybe taking the balls in their court very much compared to 6 months before that. But I don't think it means that they're shying away from the sector by any stretch, because there's so much capital already earmarked for Web.
These investors, what's a profile of these investors? Because we're coming from an institutional FOMO type of perspective. Are they as institutional as some of the teams that we're talking with last year, or has that demographic changed?
Yeah, no, I think it's largely the same. I think that it's institutional and it's a lot of family office, actually. And I think it's a lot of family office mainly because of the nature of decision making, because This is a category that is a long-term investment. Obviously, nobody expects there to be a crazy bull market in the next 6 months. And so I think it's for people who have a longer-term view as to how
Don't
they
say that
manage
too loud,
capital.
Robby. Don't say it too loud.
Um, well, better to underpromise and overdeliver. So I think it's for people who have a long-term view, but also given the turbulence this year, I think for people who are, let's say, very committee driven as an investor, it may be difficult to get those committees in total agreement if they have a very broad-based decision-making process. So that's why I said family offices, because if it's up to one or two fund managers to make the decision, then I think often they're maybe taking a little bit more of an aggressive approach.
Yeah, I think what I find really interesting about digital assets is it's actually very similar to raising capital for emerging managers in the hedge fund space or even smaller VCP funds for Asia generally. When we're dealing with overseas investors where there's more steering committees or larger groups, there's always one person on the steering committee who's like, you know, do we really need that type of exposure in our portfolio right now? Can we
Exactly.
wait? There's always that one person who's sitting out in like Minnesota and they're like, I don't know. I've never seen what is a metaverse really, honestly, or what is a Hong Kong, honestly. Like why do we need to be there? It's very, very similar. So I think it's really, really encouraging that you're doing this. As a team, do you need to split up the team between the metaverse fund itself and like your internal corporate side? Because you do actually have a lot of work
Yes.
happening yeah. And how does that split or,
Yeah, absolutely. So the Metaverse Fund is, to be honest, I'm probably the biggest overlap in terms of personnel because I'm spending some of my time there as well. But otherwise, the Metaverse Fund is actually led by our managing partner, Homer Sun, who came to us from JP Morgan Private Equity, which he was running for many years. And we have a great dedicated team there. They're also located in the cyberport, so not too far away from the
hey,
mothership, so to speak.
excellent.
But no, Homer's put together a fantastic team of very seasoned fund managers that particularly have focused for their career on this growth equity stage.
Okay, awesome. I'm going to ask a couple more questions about the industry. I know you have a hard stop in about 12 minutes, so I'll try to get through these as quickly as possible. So let's talk about tokenization models. And again, to be clear, when we look at VCPE investing, we're looking at TradeFi investing into these companies, but a lot of it is reliant on how well developed or how well thought out these tokenizations models were. And you mentioned in another interview, actually with Nifty, that Axie Infinity is just one model of tokenization, this play to earn, which we're still a big believer in. Now
Yes.
that you've seen so many companies, you have so many investees underneath your portfolio, are there any models that you see now that are like, oh, this could be the next forerunner?
Sure. I think at the moment, the first thing that we have to be clear about is that companies in the space are all still experimenting. There's no sort of fixed playbook, if you will. And so we're experimenting both with technology as well as with business models. One of the things I've seen a lot of over the last, let's call it 3 to 6 months, is what we're loosely calling the Web 2.5 approach. My colleague Yat is fond of saying, are you more 2.4 or 2.6? So you have to decide. But the Web 2.5 approach is where you can start to build parallel experiences within the same application, one half of which is more Web 2, half of which is more Web 3. And so the idea is to create an in-application upgrade path. So for example, users can come in through that user acquisition funnel in a very familiar Web 2 type of way, meaning they don't have a wallet, they don't essentially participate in tokenization at all, but they still buy in-game virtual assets, they buy in-game currency, and they play, which is, it's a Web 2 experience. It's what they're familiar with. The onboarding is very simple. But what you do is then you offer the opportunity to more engaged players, once they get further into the game, once they achieve more levels, etc., to upgrade your experience. And you upgrade it by creating a profile. And by profile, we mean wallet.
Yeah.
And so they eventually take what they have and we offer them the ability to tokenize what they've already collected. So you want to kind of hook the user with a Web 2 approach that has very simple onboarding that's familiar, but then reward them with the benefits of ownership as they progress along the journey.
Yeah, I'm actually reminded of one team that you guys did last year called Beaten Arena. This was, I think this was an ASEAN team which had
Mhm.
done very well in the Google Play Store, and they had started off as a Web 2.0 company. And to your point, they would go onto the App Store, the game is downloadable, but at a certain point, you'd be encouraged to log into the desktop version where they would then help you open a wallet and then give you reward systems, etc. And I can sort of see that being quite successful for on-ramp. On that point about distribution in app stores, and mobile is a very big part of this.
Mhm.
One of the big debates right now is about Apple and Google Play Store, how they do control a lot of the gate. So is Web 2.5 your way of sort of, or the industry's way of getting around that right now? Or do you see us coming to a head? Because two parts. One is they control the gate, and number two is it's 30% tax on top. So,
Sure.
yeah.
I think, I guess the first part is that the 30% is not really the problem.
Hmm.
The 30% is what it is. It's a cost, and any business can decide whether the cost is worth it for the distribution or the marketing or what have you. I think the difficulty with specifically the way that Apple has worded their approach from a legal standpoint is that it actually doesn't really work for blockchain games. So, for example, one of the notes of clarification they made recently that people noticed was Coinbase had to remove their wallet from Apple because Apple was saying essentially that users needed to pay the 30% commission on the gas fees for the transactions, which doesn't actually make logical sense in a blockchain world. And it's not something from a transactional standpoint, it's a network cost. It's not sales revenue. So that combined with the other thing, which is that they said that you're not allowed to provide any utility to the NFTs beyond what is essentially being paid for in the App Store. I understand the concept of that, meaning they want to try to ensure that they can get 30% of any value that is transferred. But it essentially means, that here you're welcome to buy a car, just don't drive it. So it's unfortunately too blunt an instrument, this initial sort of policy that they've put out for the Web3 community, because there's not even an easy approach for us to say, okay, well, we'll pay this marketing and distribution fee. So I think that part is difficult. I think that although I do think it will change over time, and this is just the first shot at policy from Apple specifically, I think what's interesting though is the opportunity, in fact, for other big players in the ecosystem. So if we look at Apple and Google, they have the largest market share of operating systems for mobile, but they're definitely not the only game in town when it comes to mobile distribution or mobile platforms. If we wind the clock back 7 or 8 years before, let's say, Google Play, for example, had a reasonably dominant market share in Android app stores, don't forget there were lots of carrier app stores. There were lots of handset makers preloading apps on phones. And these were all distribution vectors. And those have largely struggled to survive in the face of a consolidated Google Play Store. But in a Web3 context, imagine you have a handset maker who preloads 5 million devices with wallets. Well, 5 million devices with preloaded Web3 content would mean that a single application would be the largest application in Web3 with a 5 million wallet foot.
Are you hinting on the Solana phone that's due to come out at some point?
No, not just that. We invested in a handset maker called Nothing from Carl Pei, of
Yes.
OnePlus fame, but also others, traditional handset makers. Think of Samsung and Huawei, and all these companies all have app stores on their phones. And from their perspective, this Web3 might be a way for them to get back into the App Store game. Because if they decide to be very Web3 friendly from a hardware perspective, then that's a way to attract a new audience to their handsets and devices.
I want to stay on this topic of the Goliaths coming into this space. And this is a pretty big contentious point. Sandbox, the team is doing very well. It's still in development, arguably after 7 years. But then you have these old names in the business. You mentioned last time, Tencent, who's the 800-pound gorilla. They have their hands in every single gaming company in the world. They bought out Riot back in 2011 or 2015, I think it was, for $350 million. That engine generates multiples times that on an annual. I think they're like 1.6 or 1.7 billion a year. For them to look at where you are now, even though there's a dichotomy between gamers and Web3, they're definitely looking at this space. So as
For
they
sure.
look in this space, I see one opportunity from an M&A perspective where it could be good for as you come up the ladder and they come down the ladder, there could be an emerging point. But are you seeing conversations there right now? I'm seeing some partnerships, but I haven't seen very deliberate conversations in that space.
So I think one of the things that I've observed in traditional game companies, particularly the larger ones, is you always find Web3 advocates internally on those teams and evangelists basically trying to convince those teams that they should be thinking about Web3 in terms of their product mix. But I think it's a little bit like the investment committee discussion we were having earlier. It depends on how big and corporate the decision making is at those entities. For example, we work with one of our investors is a game company called Scopely in the US, which is quite large. And they're already actively building Web3 products because leadership at the firm took a view on Web3 quite a while ago, 18 months ago, and started pursuing that direction because they have a passion for it. Whereas at other firms, I think sometimes, and Ubisoft was I'd say early adopter and took a lot of risks in trying to bring their community to Web3. I think they had some difficulties last year with a particular product launch where the community reception was not great.
Yeah,
Um,
there's some
and I
backlash.
think that, yeah, and I think that's made them a little bit tentative in terms of thinking of next moves, which is a shame. But I think these things happen slowly, keeping in mind, of course, that the Web3 game and entertainment industry is very small still.
Yeah, yeah.
I mean, I think my friend said it best. He said, we're about 10% of gaming right now in terms of investment. And so it's not that material, but it is material enough that every game company should at least figure out what your Web3 strategy is, because we've now become at least a legitimate subculture, if nothing else.
Yeah, I want to hang one more point about these larger platforms. And I recognize that there's some similarities between what Animoca is doing and, say, larger gaming platforms like Gala, for example. And Gala has kind of moved into a bigger space of television and music and film, but they have a unified token. Does Animoca have any plans on doing something similar to unify all of the IPs under its investment portfolio? Issuing like an Animoca token, for example?
It's something that we've had a lot of internal discussion about. I think the question always when considering to issue a new token is to think about what that utility is going to be and to think what is the thematic around that utility. And so we are at the moment issuing NFT collectibles and tokens of membership, if you will, for all our investee companies and supporters. But I think an Animoca token is a little bit further down the road. At the moment, we're actually quite focused on individual product ecosystems.
Got it. Got it. Yeah, absolutely. Well, look, I'm cognizant of the time. Thank you so much for joining us, Robby. Really appreciate it. On a final note, any encouraging words for Hong Kong as we kind of move into this space? A lot of great crypto firms came out of this city. Wanted to hear your thoughts there.
Sure. I think what we've seen coming out of the financial authority and some of the government issuances and proclamations over the last couple of months, I think have been extremely positive for the sector. The one thing that I noticed is that I feel like after a little bit of a COVID winter, if you will, in Hong Kong, I feel like if one thing defines Hong Kong in my experience over 40 years of spending time there, it's resilience. And I think that's being demonstrated right now. And we see it particularly in our industry too, because with a little bit of forward thinking from the part of the regulators, I think Hong Kong basically has reclaimed its mantle as a digital asset center in Asia. And in fact, it wasn't very difficult to do at all. I think it's Hong Kong's to lose, honestly.
Yeah, I love it. Hey, Sandy, mark that quote. We're going to coin that for the Twitter post right there. Hong Kong is all about resilience and it's regaining the mantle. Thank you so much, Robby, for your time. Really appreciate it. It's been awesome. I hope we shouldn't wait another year to do this. Let's do it again sometime. Good luck with the $2 billion fund. We're very excited for you and hopefully we'll talk to you soon.
Fabulous. Thank you, Alvin. Have a great day.
Take care. Bye-bye.
Bye-bye.